Good morning, ladies and gentlemen. Well, as you can see from the title of this video, I am very frustrated. I'm frustrated for several reasons. One is because we still haven't managed to fix the display in the wrist dial, but I assure you nothing is happening. We're still around 88 and we're still very much in risk on. That is the part of the trend that is continuing. I'm also frustrated because the bonds are showing no signs of giving the next direction for macro, and we are still in limbo, and we will now examine exactly where we are and what levels we need to break in the yield curve to have the next signals of where we're going. I really did think that 2's10s would give us a clue, as would 5's30s last week, but with the very mild, um, you know, 20-minute speech that Powell gave us on Friday, we are back in limbo and waiting for some concrete, something to hang our hat on. We are basically still ranging in a 5-6 basis point range. We really need to break either 119 or 98 on the downside to get the next direction in 2's10s. I really thought that the break would come to the downside and the Fed would give us more clues about its readiness to taper and the eventual timetable for tightening. I still think it's very much the same. I just think that they want to have several non-farm payrolls under their belt, so they know that the labor market is firing on all cylinders, and then they will be ready to act. I still think that the direction eventually is going to be one of bear flattening of the yield curve, but opinions are cheap. Everyone has an opinion. Price has to confirm that opinion, and price has not confirmed my opinion, and therefore I just have to wait. On a weekly basis, 5's30s did absolutely nothing. What was it? 1 or 2 basis points. We are still knocking on the door of 105 basis points to see whether we can go up to 80, 81, 82 basis points. That would be definite flattening, bear flattening, but we still haven't done it, and therefore we're still in the limbo between 124 and 105 basis points. And we will continue to range in this range, I would have thought now, until either we get a very strong NFP on Friday, or we have to wait for the FOMC in September to get more clues. Either way, I think we are stuck until Friday and nothing much coming out of that. If we look on a daily basis, we can just see up, down, up, down, up, down, and we're very much here. We need to break this area to start going up towards 81. That's what we need to do to get a clue that we are going to be bear flattening, and that, in that case, all other asset classes can follow. Until that happens, nothing. What is interesting is that the 10s, 30s keep on staying in this area as well. That to me is good news. It tells me that there is no pickup in inflation expectations. 30s would start getting destroyed compared to 10s if people thought that the Fed was not prepared to act. That is not the case. We're still there, and therefore all options are on the table. The market is not giving me any tells here as to what the next direction is, and therefore we just have to be patient. These things happen. Look at these periods here. Several weeks of going sideways, several weeks of going sideways. That is precisely what we are likely to get now. and therefore we just have to wait. I very quickly wanted to show you the twos, the outright twos, and really this is a longer term chart. What we have to do is we have to start busting through 27 to get to an area that the market can bear flatten. We can see how long we've spent in this area, and we really need confirmation above 27 to start getting bearish on the short end. The level in fives is actually becoming very clear after the price action of last week. If we enlarge it, it basically got exactly what it should have done, around 85 basis points, and retraced straight back. Now that becomes very, very important on a daily and weekly close. We really need to start busting through 85 to have a chance of bear flattening. We're not doing it. Have a look at this period here, and this is exactly what we're going to get until Friday. We really need clear signals. We have clear levels, and we need to bust those levels to start getting the next wave of the move. It's frustrating, but we have the levels. The market is giving us very clear levels, and therefore we must follow them. If we look at tens, the levels are not as clear, and therefore that is what makes me still think that the bear flattening is the most likely scenario. But really we need to start breaking above 139 for it to be bearish. We are not doing it. We keep on holding below, and that tells me that the longer part of the yield curve is the one that's bid, while the front end is the one that at some stage will be offered. If we go to 30s and we enlarge the chart of what we did last week, we can see that the 30s were the best part of the yield curve, the one that had the least upside in terms of yield and the most downside. It just would not go higher, which tells me that 30s are bid. The 30s are the ones with the least problems, and all the problems are in the twos and fives. And that's why I think that bear flattening, like I described last week, is still the most likely outcome. But price is just not confirming it, as I showed you in the chart of 5s 30s and 2s 10s, and therefore we just have to wait. In Europe, things are really not much clearer. This is the bubble, and really we know what we need. We need a break above this level, which is 68, 69 basis points, to get any impulsion on the upside. We're not getting it. We're still stuck in this range between minus 75 and minus 68. We will keep on going sideways. I think the odds of breaking 68 early next week are, until non-farm payroll on Friday, are almost zero. I think we are continuing to be stuck in this range, but it's very obvious what we need to do. If we have a look at the Bund instead, the 10-year, the level here is also very clear, is this minus 38 level. We need to break above there. And we are just not doing it. Until then, we are ranging between minus 47 and minus 38, 8-9 basis points. And really, whichever chart you look at, whether it's the spread between Italy and Bunds, not much happening. The clearest chart, which is to me the chart of the yield of the OAT, that also has very clear levels. We need to start busting through 00 for it to start looking bearish again in terms of yield, and we're not doing it. But we are holding these levels. As long as we're not below minus 10, the probabilities are still up to the upside. But basically, both US and Europe are not giving any clues at the moment, and we just have to wait. The one that's, probably the one that tells the story is the one of yield differential between the US and Germany. It's stuck really at this 175 basis points, up down a couple of basis points, but stuck at around 175. This will probably give us the best clue. Either we bust through 180 or we come all the way back down to 156 and probably down to 152. We just have to wait. I think it's going to be all on non-farm payrolls on Friday, and if that's not it, then we just have to wait for mid-September for the next FOMC meeting. I know it's very frustrating. I'm very frustrated too, but that is it. Price has to confirm. The inertia in bonds, in the yield curve, and in the differential between Europe and the US is frustrating in DXY as well, and it's reflected in it. We tried above 93.14 Friday. We couldn't hold it simply because, it is what it is when Powell gives us absolutely no hint at all. And basically all we've done is retrace slightly. If we enlarge this, we will see that really the only thing that matters is this 91, this area here, which is reflected in 91.41 on the dailies where all the moving averages are. I really don't think that any ranging down to 91.41 has any importance whatsoever. We could easily then from there mount an attack back up above 93.14. So it's all to play for. The dollar is saying exactly the same thing as the bonds and the yield curve. And that is good insofar as these markets are all becoming into sync. They're all coming into sync, and therefore they'll all be able to move at the same time. It just needs a little bit more time for it to perfectly sync, and then we are ready to make a big move. But I think that any dip down to 91.41 now, I'm going to be a bit of a buyer. I think I have a better, a better setup to trade against. In terms of Euro USD, the equivalent levels are very clear. It's around 119.88, and if we look at these moving averages on the weeklies, we know it's somewhere between basically 119.50 and 120. So 119.88, and that is basically what you're looking for to trade against. I think the risk reward there is very good for another leg lower. And that would tell me then, if that does start to happen, is that the yield curve will definitely bear flatten. That is what I'm looking for. I'm going to wait for these levels. If nothing comes, nothing comes. The dollar reversed slightly, as we've seen, and therefore gold had a decent week. Bonds did nothing, therefore they were neutral for it. And here we are at 1820. To me, nothing has changed. We really have to break this on a weekly basis. We have to break this 1830, 1840 area where we have 1, 2, 3 weekly highs. And, if we look on the dailies, the 200-day moving average, it's pretty obvious. We really need to break that level and stay above it to have any chance to go up to 1900, 1910. It's neutral. It's neutral, but it's, you can see all the Bollinger Bands are coming in. It basically says that at some stage we're going to have a big move, either through 1840, in which case we probably have at least $100 move on the upside, or we basically roll over back down to 1700 and these lows are down here. And it all depends on what the yield curve does. What's interesting actually is that we've done absolutely nothing in terms of asset spreads of gold, and we'll look at that next. And here we are, SPY over GLD and AIU over TLT. We're still not breaking the very important level against bonds on the downside, 2162, which maintains the overall bullish structure of gold against TLT. But I think the trend against SPY is completely unchanged, giving us still the same butterfly, i.e. long equities and short bonds against gold. So gold is in the middle somewhere. It's slightly better than bonds and it's much worse than equities. Nothing has changed. This week made no changes at all, so no changes in asset allocation. You don't have to buy more gold or whatever. And therefore that says that nothing much is changing still, and that 1840 is the swing level. But I don't see it broken, certainly not until NFP on Friday. To me, DBC continues to be a much better long than gold as an alternative. What did we do? We gapped up and continued higher. As long as it maintains this kind of a structure above these very important levels at 1868, 1841, the odds are that it breaks this level, which is the highest weekly close, and continues up. 1950, you can put it in there. As soon as it closes above 1950 on a weekly basis, I think the path of least resistance is well higher. It just seems weird to me that we would not be getting back to at least this level, this 24.39, at a time when people are so concerned about inflation. Commodities are likely to perform much better in periods where people are afraid of inflation. And really, if you say that this is a 1, 2, 3, 4, 5, it seems much more likely to me that we are going to be at least at these levels in commodities before gold has a real chance of making new highs. And therefore, this being, a 20% move here, I think in percentage terms, DBC is much more likely to perform than gold. If we look at the ratio chart of gold over DBC, we have a very natural equilibrium level at 638. This level goes all the way back years, and we really busted much higher away from it, and we have returned to it, and I think we're returning to this equilibrium level at 638. And given the fact that we are just at 9, that gives us a 25% move when we return there, which is really basically saying that gold is going to remain stable while commodities perform quite a bit better. To me, that has not changed. To me, the trend of DBC is one of outperformance against gold until we get to at least 638, and that would match with with those levels that I showed you in DBC, that will return to the 20s while gold remains relatively stable. I want to start the equity review this week with EEM because of a very interesting thing that I've been reading all the material for the Jackson Hole conference, everything that they've published on site, and I think it's worthwhile you doing too. You can download it from the website that I sent you a link for. it seems that they are all very worried about emerging markets plunging the world into another recession because of the low vaccination rates, because if the Fed starts now hiking rates, the dollar might get stronger and therefore pancake EEM. If you read just about every paper that is published there, is they're worried about EEM in relation to the developed markets. They're basically saying that we are big, it's a tale of two cities. You have developed markets doing relatively well, and you have EEM where the big dangers are because of the COVID situation, because of their poor healthcare systems, because of high commodity prices, because the potential of the dollar going higher, because the Fed starts tightening. All these things are in there in the background. And that is actually what we have seen. And my experience is that what the market is prepared for, you don't have to worry about. Now, you can see where we were in the beginning of 2021 and where we are now. We are much lower, and basically the market has recognized all these potential differences in the path of COVID, in the path of the dollar, in the path of growth, and therefore that is not something that we should be worried about because the market is positioned for it. Whether it has more dips down towards this 48 level, well, yep, so what? But really, when you look at these spreads, you can see that the situation is well under control in EEM. The market, you have, this is EEM over EWJ, i.e. Japan. You can see that that relationship is very stable. Japan and EEM seem to be wedded. Against stocks, it's turning down, but it's nothing dramatic. Okay, so all we have undone is the outperformance that we had, but we are at levels going, consistent with Europe against EEM going all the way back to 2010. Okay, so we have a decade of stability between between those spreads. What we have certainly is a complete downtrend and a continuation of a downtrend, but we are at levels that are, we are bouncing from. So I really would not be worried about EM taking us into another crisis. That is something that the market is prepared for, and therefore that is not something that is likely to be a problem. If we look at what has been happening in the Nikkei, which is the one that I've showed you is absolutely wedded to EEM, we can see that basically we keep on bouncing from the level that we should bounce from, which is 26,910. That level has been solid and we've been bouncing, but it still is not. And you can see how we really need to trade above 28,335 for this to assume any leadership and to show that EEM is out of the woods. I think that the moment that EEM is out of the woods, you will see good performance in it, i.e. probably a 10% outperformance against the US. And therefore the US will be supported. The US can give up 1 or 2%, but it's not going to crash. So that is what I'm looking for. I'm looking for basically some leadership from EEM and the Nikkei. Until I get it, I'm not going to be playing overweights in these markets. It's just not worth it. Everyone's worried about it, which makes me more comfortable to buy the dip, but it certainly doesn't make me more comfortable to chase above this 28,335 level. Well, what to say about the US apart from the fact that it's absolutely fully valued? It's fully valued, but it's not doing very much wrong. Every time it dips below a previous high, the next day we go straight back up. You can't say that this is a weak market by any stretch of the imagination. What you can say is that it has very, very clear support levels, and that it just holds them, and it holds them very well. I have a tentative support level now at 44.7970, and really I would not like to see it close below that, because if we do again, I think we come down to 44.23. But it's going to be so hard to bust these levels now, very hard indeed. What that shows me is that the market is fully valued, but people really can't see a much better alternative. When people can't see a much better alternative, odds are is that there is one. And I think I'm getting slightly more bullish of EEM, simply because everyone is so bearish of it. But, it's not really a valid theory until price confirms. If you look at the weeklies, well, basically we are just crawling up, touching the top band, and that is all there is to it. Where does the top band come in next week? 45.30s, 45.40s. But the gains, this sideways action and new highs all the time, it is just not bearish. It just says that the market is fully valued, but every time there's a dip, there are buyers, and also there are buybacks from companies. As you know, the level of 45.10 is important, because 205 times a 22 multiple, that's where we are, 4,510. Fully valued, but not weak. You really can't sell it. NQ keeps on trucking. It hasn't got huge amount of leadership. That's because the yield curve hasn't moved, but it's holding its own and a little bit more. So you really can't be bearish of it. I mean, you just can't. The levels are very clear. Now we have clear support at 15,185. We really don't want to see it below there, but the impulsion is there and there are really no problems. It continues up, it continues to touch the top of the weekly Bollingers. The objective next week is going to be in the 15,700s. The one that did quite a bit better on Friday is, and last week in general, is IWM, the Russell. Clear ranges, 211, 234. It's probably going to remain in those ranges next week. But, if you look at it on a weekly basis, you have very, very clear now that when we start busting either this 210.63 or 233.59, the trend is going to be very powerful. This is consolidation basically since January. Since January, we have done, middle of January, let's say, we have done nothing. When we bust one way or another, it's going to be a big move. It's going to be at least that much on top or that much on the bottom. So again, we have to wait. That's all there is to it. My bet is that it comes on top, but what the hell, I'm going to wait and go with it. In terms of tech spreads, nothing much happened last week because the yield curve didn't move as I thought it might. But if we have a look at QQQ against SPY, it's definitely holding its own, right? I mean, there's no problems there. We will know that something is happening when we start breaking this 85 level, and that is what I eventually expect to happen. And I expect it to happen because the yield curve bear flattens. But if we look at it against the relationship against DJI, it's even more evident, right? I mean, we've been in this range since July of last year, and we are breaking out of it. Here we had a false break, but here we are breaking out of it again, indicating to me that the growth is going to be in NDX, and that's where the smart money still is. As soon as that breaks, I would have thought that that is going to be because the yield curve breaks too. Volatility has actually been a quite good tell about what the market is likely to do, simply because as long as it can't keep above 2005, and I'll enlarge this chart for you, it's very obvious that as long as it can't maintain more than a couple of days above 2005, all the pressure disappears. Has a spike above 2005, closes above there, the next day smack below 2005, back down. It tries to touch 2005, doesn't close above it, smack all the way back down to the 15s. So what really we need to look out for is that it settles above 2005 for several days before any sustained pressure can come onto SPX. Until that happens, the path of least resistance is still higher. What seems to be obvious that is happening is that every time there are dips, more money naturally comes into the market, more buybacks hit. People are just comfortable owning SPX. It's a no-brainer, it seems. That is only going to be changed by facts, and that is when there are several days above 2005 in volatility. Until then, you can forget it. And with that, onto the bias levels. I've updated every single level to make it much more precise, but I really don't think that next week anything much is going to happen until non-farm payroll. And to me, the yield curve is still the most important one. I think 530s and 210s, the levels are so obvious that when we start breaking these levels, then we will have a big move in all assets. Until that happens, I think it's more or less more of the same. Every time the SPX dips 20 ticks, there'll be buyers, and that's all there is to it. To me, it's a frustrating time, but it's a time when it's very, very important to wait for the break and the price confirmation of one's theory. Thank you very much indeed, and tweet you on Monday.